Let's talk financing 101. This is going to be your guide to financing whether you're house hacking or an investment loan. So quick note, let me just put this disclaimer out there. I am not a lender. This video is based solely on my experience with helping clients buy duplexes, multifamily, and investment properties right here in the Houston area. Always consult with a licensed lender to review your personal numbers and options. So the financing you choose impacts everything: how much you need for your down payment, what your monthly mortgage payment will be, and even the types of properties that you can buy. For example, a 3.5% FHA house hack is very different from a 20% down investment loan. So understanding your options up front help you pick the best strategy that fits your goals. Let's talk FHA loans. FHA loans are the most popular starting point for house hackers, and here's why. Because of the low down payment, as little as 3.5% down. It can cover up to 4 units if you plan to live in 1 unit, but for triplexes and fourplexes, the property must pass the self-sufficiency test, meaning the projected rental income needs to cover the mortgage payment. Easier credit and income requirements compared to a conventional loan. But here's the catch. You must live in the property for at least 1 year, and the property has to be in livable condition. This means there can be no safety or structural issues. Here in Houston, that often means you'll be purchasing a new construction duplex or a newer duplex. Now let's talk conventional loans. Conventional loans are a great step up for both first-time buyers and investors. And here's why people choose them. There's more flexibility with refinancing or scaling later down the line. You get better long-term options for removing the premium mortgage insurance when your property hits 20% equity. You also get more competitive interest rates, especially when you have a stronger credit score. For owner-occupied multifamily, the minimum down payment is typically 5% down with a conventional loan. While true to that, investment properties typically require 15 to 25% down. These loans have stricter credit and income requirements, but they're a strong choice for buyers who are looking to grow their portfolio. If you're a veteran or an active duty service member, the VA loan is one of the most powerful tools for home buying, period, especially when it comes down to multifamily. And here's why. You get 0 down and no premium mortgage insurance, keeping your upfront costs low. You'll need to live in one of the units for at least a year, but it makes it perfect for house hacking. You also get more favorable or competitive interest rates that are often better than FHA or conventional loan programs. But when using projected rental income to qualify for buying these properties with multiple units, lenders often require 6 months of reserves. So that means principal, interest, taxes, and insurance in the bank to show that you can cover the mortgage payment if there's a vacancy. And experience sometimes matters. Some lenders may want to see that you have landlord experience or proof of property management if you're planning to count the rental income towards your qualifications. Like FHA, the property must meet VA safety and structural standards. So no heavy fixer-uppers. They typically won't qualify without some type of repairs being done. When you're buying a property strictly as an investment, your financing options look a little different. These loans generally require 15 to 25% down depending on the program and the property type. You must have a solid credit profile and cash reserves to show that you can manage expenses. Strong income documentation, or in some cases, projected rental income to support your loan. Here are the 3 most common types of investment loans. The first one is a conventional loan. This is best for buyers with strong credit and income who want predictable terms. The second one is a DSCR loan. DSCR stands for debt service coverage ratio type of loans. This is approval based solely on the property's projected rental income rather than your personal income, making it ideal for investors scaling their portfolio quickly. And the last ones are portfolio loans. Portfolio loans are typically offered by small banks or credit unions. And these loans are great for unique situations like mixed use properties or when you want to finance multiple properties under one loan. The benefit of investment loans is that there are no occupancy requirements, giving you the freedom to buy in different locations and build your portfolio faster. If you're a first-time home buyer or you want to offset your living expenses, FHA or VA is the way to go. If you're looking to scale your portfolio quickly, conventional or DSCR loans might be a better option for long-term growth. And if you want to balance both, you can house hack now, build equity, and then refinance into a conventional or investment loan later down the line. Numbers will always tell you all the real story. Connecting with the lender early helps you understand your buying power and tailor your strategy. My team partners with lenders all across the Houston area who specialize in FHA, VA, conventional, and investment loans. So if you don't know where to start, we can connect you with someone who will walk you through the details. Financing does not have to be intimidating. Once you understand your options, it becomes a tool to build a lifestyle and a portfolio that you want. So if you're ready to explore your options or need a referral to a lender, reach out to our team. Let's build a strategy that aligns with your goals and get you one step closer to owning your next property.